Okay, so I referred to recognition exceptions. So this is what we're going to go through now. There are 3 recognition exceptions. So if you have a temporary difference, you need to determine whether or not a recognition exception applies. If the recognition exceptions apply, you do not need to recognize a DTA or DTL on that temporary difference. So the first one is goodwill. It's easy. If you see goodwill, do not recognize anything for it. The other 2 recognition exceptions are the initial recognition exception and the one relating to investments in your associates and subsidiaries. So we'll look at the initial recognition exception first. So it obviously does not apply to investments because there's one specifically for them. The initial recognition exception says, do not recognize a DTA or DTL if the transaction is not a purchase of a business or an entity with a business, and at the time of the transaction, there is no impact on accounting and taxable profits. So at the time of that transaction purchase. And this is the new addition that has been put in to WSB 112. At the time of the transaction, you do not recognize the same DTL with an offsetting DTA with an offsetting DTL. And the purpose of this addition is basically to clarify that the initial recognition exception does not apply to right of use assets. So when you have a right of use asset, you have a DTA and a DTL being recognized at the same time. So let's look at a simple example. You acquire a luxury car for 200,000, and the tax base of a depreciating asset, as I mentioned, will equal the tax written down value. And cars are subjected to a car limit. I have 57,581 there. That number has changed. The difference between the 257 is 142,000. So by virtue of buying that luxury car, you have triggered a taxable difference of 142,000. The question is, do you need to recognize a deferred tax liability on that taxable temporary difference? So let's go through the criteria. When you bought that car, were you buying a business or an entity with a business? The answer is no, so I can tick that. At the time of the transaction, was there an impact on accounting profit and taxable income? The answer is no, because it's a balance sheet entry, so I tick that. So the initial recognition exception applies. Although you have a taxable temporary difference, you do not need to recognize a deferred tax liability on it. However, in your financial statements, you do need to disclose all your temporary differences, which you do not recognize a deferred tax balance. So the next one is investment in subsidiaries, branches, associates, and joint ventures. So temporary differences can arise at the consolidation level or at the parent entity accounts level. The exception says that you do not need to recognize a deferred tax liability for the associate or for the subsidiary if the carrying amount differs from the tax base. If you can show that you control the dividend policies of the investee, and you control when you choose to dispose of that investment. And secondly, it is unlikely that you're gonna receive an unfranked dividend, or you're gonna sell that investment in the foreseeable future for a gain. In terms of a DTA, a deferred tax asset, that means you have an unrealized capital loss. The same criteria as I mentioned earlier would apply. So finally, disclosures. So WSB 112 requires certain disclosures to be made in your financial statements. The key one being that you do need to break up your income tax expense to its various components. Secondly, you need to provide reconciliation. You start with your accounting profit, multiplied by your corporate tax rate, and then you need to show all the adjustments, which brings that amount to your income tax expense number. You also need to provide a breakdown of your deferred tax asset and liability balances,